So we're going to start our webinar now, and I want to thank everyone for joining us today for Strategic Lifelines quarterly webinar. If this is your first time attending our webinars, welcome. To our returning attendees, we are happy you are able to join us once again. We hope you will all find the presentation informational. As a matter of fact, we know you will. We will be sure to stay to your hourly commitment with a 45-minute presentation, followed by a 15-minute Q&A. Please feel free to put your questions in the Q&A section at the bottom of the meeting throughout the presentation, and we will answer them at the conclusion of the presentation. If we run out of time, as we hold ourselves to the 1 hour, we will make sure that all questions are answered in a future email if we don't get to them. So our topic today is creative year-end tax planning, which is unique strategies to reduce income and capital gains tax. Before we begin, let's take note of some of our upcoming events. We run monthly case studies here at Strategic Lifelines, and our next one is scheduled for Tuesday, November 16th at 1 p.m. And it's a case study on the value of an insurance policy audit. And then in December, again on Tuesday at 1 p.m., we'll have an additional case study, strategies to reward and retain key employees. And then in January, we will have our next quarterly webinar, the value of understanding premium financing for your high net worth clients. Want you to take note of these, but we will make sure that we send you an invite since you were able to attend this meeting, and we will make sure that everyone gets the information they need to attend those events. So let's talk a little bit about what we do at Strategic Lifelines. We are a direct resource for accountants, estate planning attorneys, and other professionals to help their high net worth and business owner clients mitigate the impact of taxes. We show you how to leverage multi-generational wealth and legacy planning through the use of the most advanced tax planning strategies available under present tax code. We provide you with our intellectual capital to create appropriate strategies. Our speaker today is Fran Lynch, Managing Partner of Strategic Lifelines. Fran has been helping high net worth individuals and successful small business owners meet their financial goals and objectives since 2002. Fran's background is very unique in both medicine and business, which gives him some insight into his situations his clients face every day. Originally trained as a reconstructive foot and ankle surgeon, Fran headed a multi-office medical surgical practice for years before embarking on a successful financial career. Above all, Fran considers his true value to be showing successful people what is possible in their financial planning strategy that was previously unknown to them. He brings a wealth of intellectual capital to the table. Fran also functions as a CPA team-based model coach, helping CPAs to become better resources to their clients through holistic and comprehensive planning. In this capacity, he focuses on helping high-income net worth clients recapture money normally lost to taxes and leverage multi-generational wealth through the use of the most advanced tax planning strategies under the present tax code. Fran, take it away.
Thank you, Donna. I kind of like this picture as opposed to where I am today. I had a little bit more hair, but that's neither here nor there. Welcome, everybody. And as Donna said, we're going to go about 45 minutes today. Try to leave about 15 minutes for Q&A at the end. And if you don't get a question answered, please reach out to us. We'll be happy to speak with you offline. So let's take a look right now at some of the proposed legislation and the problems that it's going to create for people. We have two enormous pending infrastructure bills right now that are being considered by Congress. One for 1.9 trillion and the other one for 3.5 trillion. The 1.9 trillion looked like it was going to be voted into law a little bit earlier this year. It got blocked largely by, you have to understand what the structure of Congress is right now between the Senate and the House of Representatives, thin margin only by the vice president's vote getting through anything in the Senate right now. So a lot of this stuff goes by partisan lines. But Joe Manchin, the senator from West Virginia, blocked the $1.9 trillion bill earlier this year simply because he didn't like the unemployment aspects of the bill and some of the credits that people were going to receive and the income on it. And they've really put their full attention right now is going forward with this $3.5 million or $1 trillion bill. In that bill, again, we're up against a situation where they're going to need complete partisan voting across Democratic lines to get this through. And right now, the two holdouts are, again, Senator Manchin from West Virginia and Kristen Sinema from Arizona. And Manchin is hell-bent on not seeing his bill go above $1.5 trillion. He really thinks that if we go much above that, we're really going to fuel inflation. And he's got some real concerns with a lot of the Green Deal stuff and a lot of the efficient energy. So they're still battling how this is going to turn out one way or another. I don't think it's going to end up between these two bills being anywhere near the 5.5 trillion that it was originally proposed. But I will tell you this, there are embedded in these bills some things that would shock you, including a lot of other taxes such as mileage tax, things of this nature that if you've read that $3.5 trillion bill, it's 2,700 pages long. I don't even think a lot of the congressmen and senators that are going to vote on this thing have actually read it. You'd be shocked some of the things that are in there in terms of, quicker paths for citizenship for illegal immigrants. And again, this mileage tax and whatever. But one way or another, these bills are going to eventually be passed. Now, if you think about where we sit right now, we've got a roughly $29 trillion debt in this country. If you haven't done so already, an interesting exercise is go to the usdebtclock.org site, and you can literally watch the US debt click up in front of your eyes by millions of dollars just sitting there. It's almost a scary thing to see. So at $29 trillion, you add a couple $1 trillion more of debt just coming out of these infrastructure bills, it puts the United States in a pretty heavy debt position. So whatever version of these proposed bills become final law, I can't imagine that it won't require in large part funding via increase in tax revenues. In fact, Manchin has said that whereas Biden doesn't feel that the bills have to be completely supported by increases in taxes, even though Manchin is looking to keep it to 1.5 trillion on that second bill listed here today, he wants it paid completely by taxes. So with this in mind, I guess the question becomes, how would you anticipate that future taxes are going to look for you? You think they're going to be the same? They're going to be lower or higher? I think the answer to that is probably pretty obvious. So some of these proposed potential changes, and I got to be honest with you, these are just the major ones. I mean, they're as long as my grandkids list for wish list for their Christmas presents. But some of the majors ones are increase in marginal tax rates for households with incomes above $400,000. Right now it's 37%. It would go to 39.6%. Increase in corporate tax brackets to 25%. It presently sits at 21%. So it's obviously going to affect businesses. Increase in capital gains tax for households with incomes above 400. Where it would go to 28.8% is to move it up to 25%. But then with the Obama Medicare surcharge of 3.8%, it would go up to 28.8. That's almost 30%. And the scary part about this is if it goes through and is voted into law from legislation, it's likely to be retroactive back to September 13th. They've got it now, albeit it probably won't affect a lot of households, but if you've got a household income of greater than 5 million, we're looking at additional surcharges of up to 3%. Let's face it, that's a loss of $150,000 for somebody making 5 million. That's not chump change. Increase in Social Security tax for high net worth households. Presently, you pay 6.2% up to a threshold of $142,800, in Social Security tax. And obviously, if you employ people that are W-2, you might as well double that because you pay their share also. What they're considering is having a blackout period above $142,800, but then again at $400,000, it kicking back in again. So that could be a substantial impact to your tax bill. There's a cap proposed on itemized deductions up to 28%. I know that might not seem like much on first blush, but believe it or not, we've looked at a lot of client situations, and this could actually impact your ability to maximally fund your qualified benefit plans. We've seen people basically, if this was to be enacted into law, that are putting away up to $18,000 a year in 401ks that would be capped at about $5,600. This is unlikely, but they're looking at eliminating the step up in basis upon death. If you inherit assets, what happens is you inherit the basis of the value of those assets at the time that you inherit them. But if you have to take the original cost basis, then you're going to have gain recognized at death. That could be a substantial tax bill. And two of the things that seem more likely to happen, and we're holding on any significant recommendations for estate planning until things become a little clearer, is, right now, if a couple can actually protect up to almost $24 million from federal tax upon passing it to the next generation inheritance between using both spousal exclusions, and that's indexed inflation. It's supposed to go back to around 6 million when it sunsets on December 31st, 2025. But right now, what they're doing is looking at bringing it back down to 5.9 million per spouse, which means that where you wouldn't have had any federal inheritance tax above a $12 million estate or a $24 million estate, it could now kick in at 12 million. And they're also looking at increasing the percentage that they would take from 40 to as high as 50, 55%. So that's going to be something to keep an eye on. The other thing, which is a real big issue, is there might be changes to the grantor trusts. They're what they call grantor defective trusts. And for a lot of people that have done planning where they have life insurance and irrevocable life insurance trust, those are usually grantor defective trusts. And some of these laws might say that if you paid a premium, made a gift to the trust after January 1st, 2022, it would claw the death benefit back into your estate. So there might be other things that we have to do to plan around that. And it would leave people in a tough situation that have ongoing premium payments for insurance that are sitting in trust if it's going to claw it back into their estate. So these are just some of the proposed potential changes to tax and estate law that we should keep on our radar screen. And obviously, as they develop, we're trying to keep our clients abreast of the things they need to know as they do their year-end tax planning and move into next year. So here's the bottom line. We feel it's fairly safe to assume that in whatever form final legislation is enacted, taxes are going up. So there's probably never been a more important time to really take a look at and work with groups of people that can help you look at mitigating your tax exposure, especially when you look at the direction that we're going. Now, this particular talk today is not meant to spend a ton of time on basic year-end tax planning. We want to get on to some of these more advanced planning structures that two in particular we'll talk about. But some of the basic year-end tax planning we've just listed here. And I would say to you, you really need to get with your CPA. Hopefully you're working with a CPA that's not just filing taxes and doing your compliance work, but is really proactively giving you tax advice. And having a meeting in the last quarter of the year is a good idea. Anybody that's not getting that service, that would like to consult with us and run a situation by us, we'd be happy to talk to them about it. But your basic classic ongoing year-end tax planning has usually been, defer income until 2022. So if you got bonuses or you can do delayed billings, and if you have a small business, that'll push some income out, obviously, into 2022. It'll reduce your taxable income for the year. Making charitable donations will give you a tax deduction. Take advantage of what's called tax loss harvesting. So if you've got a brokerage account and you've got gains in that account, you can actually offset up to $3,000 with losses, and you can carry those over year to year. Maximally contribute to your retirement accounts, whether they be your IRA, your 401k, your SEP plan. One thing that's often overlooked by small business owners is you can employ your children and you can pay them up to $2,200 a year, and they will be taxed at their bracket. So it's a great way to get money into their hands you're going to spend for them on one source or for one reason or another during the course of the year, and have it be taxed in the lower income bracket. And the other thing that you can do is remember, if they work for you, there are other business expenses that you can deduct. They might have gas expenses or things of that nature. So you have to, take a close look at that. Make absolutely sure if you're retired and above 72 and a half years of age, that you're taking your required minimum distributions, because the penalty for not doing so is pretty hefty. And remember, last year they suspended ERMDs because of COVID, but this year you have to take them again. Contributing to your FSAs, HSAs, your flexible spending, and your health savings accounts, as well as your 529 plans, will give you some tax relief. Do understand, however, that where an HSA will allow you, if you do not use the funds, to carry it over to the subsequent year. The FSA is a use it or lose it. So you want to make absolutely sure whatever you fund into that account will be used by the end of the year. In terms of 529 plans, usually those plans don't have a deduction on the contribution, only on the growth and the distribution. But in certain states, you get up to a $10,000 deduction household on a state tax level for funding a 529 plan. And the only other thing that we tell you is be aware of where you might fall into an AMT situation by consulting with your tax counsel or your CPA. And always take a look at, standard deductions versus itemizing, because, the single deduction right now is $12,550. Households is just over 25,000 to 25,100. But a lot of times, and actually 80% of the people are taking that standardized deduction today. Shockingly, there are situations we've looked at where if they itemize, they can actually get more deductions. So these are some of the basic year-end tax planning. Where we're going to focus our attention today is on two very creative strategies for reducing income and gains tax. These are more applicable to higher income individuals or those that are selling capitally appreciated assets. And we're going to talk about two particular areas. The first, which my partner will cover, is next generation pension planning. We call them modern pension plans. We're going to talk a little bit about the cash balance plan with or without the inclusion of life insurance. We're going to talk about the fully insured plan, which is called the 412E3. It used to be called the 412I. And then the plan which gives you the largest deduction, which is a benefit-focused pension plan. Then he's going to flip it back to me, and I'm going to talk about a proprietary version of what's known as a Charitable Llc, which we call the Ideal Plan, which has some significant tax benefits and philanthropic benefits. So that said, I'm going to turn this over to my lifelong friend, my partner, my mentor, Gene Frost. Gene has got a 40+ year history in the insurance and investment arena. He is one of the top MDs ever to be involved with Northwestern Mutual, and then at a later date over at Mass Mutual. And he's been a longtime member and qualifier of the prestigious MDRT $1 Million Roundtable, and probably one of the greatest specialists I know in pension and non-qualified deferred comp planning. So that said, Gene, I'll turn it over to you.
I popped up. There you go. Hi. Good afternoon, everybody. I wanted, Fran, can you just go back to that first, the other slide for 1 second, the one you just left? What I want to kind of do is I'm going to walk you through today some of the strategies we can do to maximize deferrals and contributions in the qualified plans. What I've learned over the years with pension plans is that I know what I know, but sometimes I'm really surprised about what I don't know, and how often I'm surprised at the things we can do in our design. And kind of just tell you a story first, and then we're going to go through to share the overview of these plans and how to maximize them. But we got referred to a air conditioning and heating contractor who effectively had 25 full-time employees, paying income on about $1.2 million a year of net income, 2 sons in the business. And they already were doing a 401k profit sharing plan and putting away 5% for the profit sharing plan, and was doing a dollar for dollar match into his 401k. And his goal was to retain his people. They've been with him all along. They helped him build his company, really want to take care of his people. And when I went in there, I said, we may be able to put you in your own plan and shelter a lot of money. And he said, well, I've looked at this before, we couldn't. And we went to the actuary. And to make a long story very short, we kept the existing plan as is and added a second plan on top of it, his own cash balance pension plan. And we were able to put away $220,000 for him. We also decided with his accountant's blessing to put his wife on the payroll, have her come to work, and we were able to put away another $75,000 for her. So we got a deduction of close to $300,000 a year on top of what he was already doing. And just to kind of, and I wasn't, when you're able to, there's a number that we can use that if you have an existing 401k or profit sharing plan, usually somewhere around 7.5% of employee salary as a contribution can many times offset what can go into the cash balance plan for the owners. And if your goal is to reward and retain and do a 401k match, it does create opportunities that sometimes we walk by. For many, many years, we thought if we had less than 10 employees, it worked ideally. But in this case, we had over 25 full-time people. People have come and grown. We're up to 30 people. We still have him in his own standalone plan. The second plan, which some of you may know or not know about, is called a 412E pension plan. And these are actually designed by insurance companies. And this is how most pensions were funded in the early 60s and 70s with union plans and the big automotive dealerships. And effectively what they did is they used life insurance and annuities to fund retirement. And everything was based upon the guarantees of those contracts were somewhere between 2 to 3%. And they allow you to take an enormous deduction up front for the right situation. So we had a client who was a dean at a university, making a very high salary. His wife was a dean at the same college in another department. And both of them were making very, very big incomes, fully covered by the university. But they had an outside consulting business. And they were making close to $2 million a year. And they were only doing a set. Well, we came in and he wanted no market risk. He wanted total safety and he wanted the biggest deduction possible. And we put him into a 412B plan and he was able with his wife to put away close to $700,000 total, all fully guaranteed, all code. So the point is in both those situations, the existing advisors missed that opportunity and the existing advisor on the 401k plan missed that opportunity. And you just really don't know what you don't know in this world. And sometimes you just do the study and you're amazed at what you can do. And the last one's called a benefit focus plan, where if a person really wants the largest deduction, rather than funding for a lump sum, by funding for a joint survivor annuity, we're able to get almost 35 to 40% more value in a retirement fund. Next page, Fran. I just want to kind of, I always joke on this. Let me tell you the story before, the punchline before the joke. So today we're able to do so many more things and so much more flexibility and so much more design. Now there are two types of retirement plans. You have your defined contribution, which effectively is your 401k, it is your IRA, it is your profit sharing contribution, which is percentage of pay or a dollar amount. So if I'm making $200,000 and I'm putting away 5% of salary, that's 10 grand a year. I don't know what that account's going to go to. It's just a function of future investment returns. The variable is what I end up with. I know what I'm putting into. That's the defined contribution. In the defined benefit world, we know we're going to end up as a benefit, and we're going to assume based upon an interest rate how much we have to put away each and every year to get to that number. Today, we're able to use up to $285,000 of salary. Next page, Fran. Today, we're able to use up to $285,000 of salary, and we're able to fund for almost a lump sum of $3 million. So if you think about it logically, if I'm going to fund for $3 million and I can use an actuarial assumption of 4 or 5% as a number, and I'm 55 or 60 years old, how much money can I put away over the next 5 to 10 years of my life in order to fund that for that future liability? And that allows us to get this significantly larger deduction and with great flexibility today. So this type of plan, I'm not going to read this to you for time purposes, because I would rather go through the numbers and explain the value of this. But effectively, this allows us to set up a niche retirement plan supplemental to a 401k plan. In the right situation, it can be layered on top. Sometimes you may have to add back a small contribution in the 401k plan. But if the census works well, it is always worth to do the study to see what the owner can put away or the owners can put away for themselves. The contributions are tax deductible and they grow tax deferred. It gives us much higher creditor limits. It creates a whole nother layer of creditor protection. And there's enormous flexible plan design. We can use ranges today. Years ago, you were so stuck with your normal cost. The actuary said at 5%, you got to put away 100 grand this year. And next year we'll go up and down a little bit. But today, by able to figure out what the future target is, we have a range and we can either pre-fund that liability and put more money away today or less money, catch up. So we have an awful lot of flexibility in what we want to do. So let's kind of go through understanding how to do this cash balance plan. And this is really the ultimate modern plan, because we're going to layer in a 401k plan. We're going to layer in a profit sharing plan. We're going to give the option, but not the obligation, to actually put in a Roth feature, which we are allowed to do. And we're going to put in the cash balance contribution. And we're even going to, we even have the option of adding life insurance to the cash balance plan, where for the business owner, this may give them a whole nother opportunity for estate planning and use basically tax deductible dollars to provide tax-free benefits for their family. And if you do happen to add life insurance to the plan, you're able to get a much higher deduction, and the premiums are paid with deductible dollars. The cash balance plan allows for a much wider range of contributions. In the illustration we're going to look at, effectively, this person can put away anywhere between basically $60,000 and $456,000 as a contribution. We're going to obviously start off with a higher contribution, but if we get into a year where business is different or cycles are different, we can always reduce down the contributions. And then included in there is the life insurance. So this was an example that we actually got last year, where a person got involved in a very unique business because of COVID, had an enormous blip in their income. They went from making like $200,000 to $2 million and started carrying forward for the first few years. And I hope everybody can see this. But in this situation, last year we used the 250 as compensation. And you can see if you run through this, we have two parts of this. We have the defined contribution and we got the cash balance. And so what we're going to do is we're going to put the wife on the payroll, which the accountant's blessing, for 50 grand. And we're going to have a 401k deferral, and both parties are going to put away $26,000 a year into that. We're also going to put in a profit sharing contribution of 6% of pay. So we're going to put away another $18,000 into that. So we're going to get in those two pieces into the 401k plan, $127,000 cumulatively into both. And we have the option, if we wanted to put money away into an after-tax Roth. Effectively, we immediately do it, convert to a Roth, and we have that money going in there. And you cannot do this. I mean, individually, you're capped at what you can do Roth. And this is one of the great loopholes in planning, that if you want to create a bucket of money in the future that will never be exposed to taxes, you're able to fund this, convert to a Roth immediately, and get a much, and then have this money come out tax-free at the back end. And then comes this is the key. We're able to effectively put away, and I think you can go all the way over to there, over $300,000 combined into the cash balance plan. So the two owners can get $300,000 into the cash balance plan, a $52,000 deferral, an $18,000 profit sharing contribution, and the option to do a Roth conversion. That's a huge tax savings the first year. And in the plan, because of the fact they had young children and their goal was to provide life insurance, we were able to add life insurance to the plan, which was just part of the normal cost. And we were able to provide almost $1.8 million of life insurance, which is received income tax-free by the wife, or $502,000 by the husband. So Uncle Sam has allowed us to deduct our contribution and still get our benefit out tax-free. And it's one of the very few places in the code that we can actually get a life insurance benefit out tax-free and still get to deduct the premium. And the cash values are just part of the normal cost. They're just part of the plan assets. And in this situation, we had almost $190,000 assumed tax savings the first year. Next slide, Fran. Now, one of the questions is, what's the benefit of adding life insurance to the plan? And many times we don't, because there's not a need for it. But if there's a need for it, it allows you to fund the life insurance with pre-tax dollars. It provides for a much higher deduction. If you choose, you can add it to the normal cost. You can have it built into the normal cost. And what happens is the plan has earnings. Your future contributions will kind of go up and down as planned for. But if you're using a conservative assumption around 4%, in most cases, the life insurance will match those returns and allow you to keep your contributions relatively normal. The key thing is if the person dies, in a sense, the retirement plan is fully funded and completed upon death. And then, and this is the key, when everybody asks the question, I have my death benefit in my plan pre-retirement. How can I take advantage of it as I get closer to retirement? You have the option to distribute the policy out of the plan. And you can either do it early. A lot of times we have the client buy it out within year 7 or 8 for its cash reserves. And it's one of the few ways in which to buy it out early. And then we can turn the policy into tax-free income if they choose. So not only do you get a deduction up front, not only you get the death benefit tax-free, but even more importantly, you can have the option to have some tax-free income in the back end of your life. And if you go back to what Fran went through initially, if you think about it, if taxes are going to go up, to have a bucket that can be used coming out tax-free or help you pay the taxes on the distributions from the pension plan, that's just another layer of planning strategy and diversification. The other thing the death benefit allows you to do is, I've got a bucket of $3 million and I have this death benefit. Upon my death, I have the opportunity to Roth that benefit, and I have the life insurance proceeds available to Roth it also. So there are just so many advantages in the right circumstance to use insurance in the plan. And just to kind of summarize where I started, effectively, I want to go back to the two things, the 412E, 412E plan. And I will tell you that I probably, over the last 15 years, every year or every other year, I will get a call from an accountant or attorney who says, I had a client, he's a really big high income earner. He's basically works with himself or one or two people. He wants to get the biggest deduction possible. Wants to, fund this thing for 7 to 10 years and get out. More important about the deferral and the shelter than the return. And we will use these, we'll use this in the right situation. You really need to have less than 5 employees because the rules are a little bit more stringent. The ideal situation is when you have either a consultant or you have a person who serves on a board. I've done it for board of directors. You have, an attorney that works by themselves theoretically and gets a 1099, litigation attorneys. We've had different people this is very appealing to them. And in that situation, that's a great way to get a bigger deduction with safety. And then the benefit focus plan is really for the person who wants the biggest deduction possible, wants to create a bucket of wealth for their family. And it allows us to fund for a joint 100% survivor annuity at age 65 versus the lump sum. And so when you're, so $3 million is the number we need to fund for under the lump sum. We need close to $4.5 million under the benefit focus, which allows for, basically a 40% higher contribution. So that's kind of just to give you the ballpark of what's available. And if you think about who's a candidate, as you're sitting here with your clientele, we'll get clients all over the place, and we'll get people from the medical professions. I have a young plastic surgeon who's 38 years old, making $2 million a year. He's got 2 women under the age of 30 working for him. Perfect candidate for, for a cash balance plan. Because of his age and the fact that we have a longer period of fund, we can't get that large of a deduction, but we can get total close to about $160,000 into a plan on his behalf, which is still more than the 60 grand he can put away into a SEP or a profit sharing plan. Entertainers, athletes who work by themselves. Big market is independent consultants or board of director people, mortgage brokers, the highly successful real estate agent, software developers, people in the construction trades, and any small business owner who has significant cash flow and reasonably a low number of employees. But this is no longer quite true. I mean, we can't do something if you've got 100 employees. Chances are the math doesn't work, but it is amazing if you've got somebody in that 10 to 30 range, and if you're already doing a 401k plan and or a little bit of a profit sharing element, how we can shelter more money on their behalf. And I think, and then the last page is, most cases under, age 40 or older, there are outliers. The 38-year-old works. It probably doesn't work at 35, but as we get closer to 40, it will work. It's got to be people who are making north of $500,000 a year, who are actually saving some additional dollars and not living on all their income. And the last thing we talked about was the employees. And the key thing is, the IRS, when they looks at these, they want to see a track record of usually of 2 to 5 years. And listen, with COVID, we've had people start plans for 2 years, fund them and shut them down. Obviously, COVID changed everything. And, as a matter of fact, Fran and I did our own pension plan and funded it for 2 years. And for different reasons, we decided to shut it down. So we got the biggest deduction possible. We roll over to an IRA and invest the money elsewhere. And they're obviously looking to maximize all the sources of income during retirement. And I think it's now, I'll just turn it over to Fran.
Thanks, Gene. So we're going to flip gears now. We're going to talk about what Gene and I have found very applicable in a lot of our cases, called the ideal plan. We work directly with a gentleman out of the West Coast from California who's the creator of this plan, an old IRS guy. And he has taken the concept of the Charitable Llc and designed a plan that has been airtight to the IRS for people that want to get large income tax deductions and also eliminate the gains tax on the sale of a capitally appreciated asset. And as we're going to see, as Gene said, I'm going to go to the end of the story before I go to the beginning. This is a great plan for people that have already taken advantage of everything else, whether there be basic planning strategies or a modern pension plan and anything else that they can to reduce their taxable income. And they're charitably inclined and they're looking to get even a greater deduction. Great place to use this plan. And anybody that's selling a capitally appreciated asset, the gains tax, reduces the amount of money you put in your pocket to grow wealth for the future of your family. And that's probably going to get worse if some of this pending legislation gets enacted. This is going to become even a more viable strategy. We can literally eliminate the entire tax on the gain in this particular strategy. So it's great in those particular situations. Eliminating capital gains tax on a highly appreciated asset and a large income tax deduction. So the Charitable LLC is as we said, charitable planning strategy, and it will provide obviously philanthropic benefits, but it's also going to give you significant tax relief. And if you look historically at many of the charitable planning strategies, they have some shortcomings, even though they do give you the tax deduction and you can do your philanthropic work with it. One is a substantial discounting of the charitable deduction because of lack of marketability and control. And then the biggest is really loss of control of the asset. It's a problem with a lot of people. They don't want to give up the control of the asset, but they'd like to eventually get money into the charity's hands. So the Charitable LLC really offers some great solutions to some of these traditional shortcomings of either a charitable trust or a private foundation, and has really become a very popular strategy with high profile wealthy individuals. And as I said, the ideal plan is our proprietary version of the Charitable LLC that eliminates a lot of the shortcomings of what we consider to be the generic strategy. And really at the most basic level, you're not creating a trust. The donor does not create a tax exempt organization or a trust, but they donate ownership units of their privately held LLC to a reputable charitable organization and receive a large income tax deduction equal to the fair market value with a slight discount for lack of marketability and control. But there are other tax benefits that you get. So we're going to run through this. And again, it's beyond our scope. This is a complex strategy, but once you understand it, it's easily applicable in a lot of individual situations. But we're going to give you the 30,000 foot view. The whole idea of this is not to make you an expert in this strategy, but increase your sense of awareness that you yourself may qualify for this type of a strategy and maybe should be explored before the end of the year. Working with our strategic partner out of the West Coast, usually we like a little lead time on these, but we've even had cases as late as early December that we've got done before the end of the year that people feel that this is a viable strategy, either to eliminate gains tax or for a large income tax deduction. At its basic level, there are 5 steps to this whole program or strategy. The first is establishing what we call a single member LLC. The second is funding the single member LLC. The third, and where the magic occurs, is creating a multi-member LLC through the use of a donor advisory fund and then gifting LLC units, which are distinguishable from the LLC assets, to a qualified charity. The fourth is obviously very important, which how do I access the funds? And that is usually done either through reasonable management fees or low interest rate loans. The AFR rate to take loans from these LLCs right now is so low, it's probably less than intermediate loan rate is probably less than 50 basis points. And then ultimately you have to complete the gift for this to work. So let's walk through the stages. The first one is establishing the single member LLC. You want to do it in a favorable domicile such as Delaware or Nevada. And as we said, when you establish that, it is initially a single member LLC. Now, then you've got to fund it, step 2. And you can fund the LLC with almost an unlimited number of assets. Now, theoretically, you can't put qualified assets in there, but a lot of people will use that to actually take advantage of liquidating a large qualified portfolio, and then we'll place the residual amount after the taxes are accounted for, or at least planned for, putting it into the plan, and then the deduction, the income tax deduction, they get literally offset what they paid in taxes. So it's a great conversion strategy for people that want to unwind a qualified plan that, to Gene's point earlier, are really concerned about raising, the rising tax brackets potentially for the future. So you can put cash in there, you can put bonds, stocks, real estate. A lot of people will put their business in there before sale, because obviously, as you're going to see later, you're going to eliminate the gains tax on the sale of your business if you put it in the LLC before you sell it. Okay, the entity is for profit and has obvious business purposes, holds assets, makes loans, or any other number of legitimate business purposes. And the transfer, this is very important, of the assets to the LLC will trigger no tax consequences because the single member LLC is disregarded for federal purposes. Now, the third step is, again, as I said, where the tax magic comes into play. After you go ahead and you fund the single member LLC, you then go ahead and you set up a donor advisory fund or a 501c, and then you gift any percentage of those LLC units. Those that are looking for a maximal deduction will usually donate 99% of the LLC units to a specific named charity. Now, when you set up that donor advisory fund, you convert the single member LLC to a multi-member LLC. And again, you point or gift 99% of the LLC units, not assets, to the charity. Now, here's the interesting thing about this particular strategy. You determine the length of time that this strategy is going to be in place. It can run for 30 years, 40 years. We've even seen situations where it'll run for 60 plus years, where it can be used through multiple generations as a not only charitable strategy, but a wealth management tool for families. You will get to appoint the manager of the LLC, and that manager usually is going to be you or your business or a family member. And the manager will have exclusive rights to manage the day-to-day operations of the charitable LLC or the ideal plan, but obviously has to stick to reasonable fiduciary standards. Now, if you visualize this on a schematic, here's step one. We go in and we set up this single member LLC in a favorable domicile. Step two, we then take the assets and we place them into the single member LLC. And again, there's no tax to the donor or the individual that makes that contribution because it's disregarded for federal tax purposes. And then you convert the single member LLC in step three to a multi-member LLC, and you gift, say, up to 99% of the LLC units to the donor advisory fund or the 501c. Now, the first thing that happens when you do that is you get a large income tax deduction. Now, it has to be discounted, obviously, for lack of marketability and control. But we're finding that historically that our strategic alliance is getting about 90 cents on the dollar, reasonably accepted by the IRS. Understand that you will not be able to necessarily take that full deduction. So let's use an example of $1 million. Somebody that puts $1 million into that LLC is going to be entitled to deduct about $900,000. Now, if it's a business entity or it's a stock or bond portfolio, they may be limited to 30% of that against their AGI in year one. But the beauty about that is it can be carried forward to up to 5 years until that complete deduction is taken. So there's an ability right there to actually take $900,000 worth of deduction against your AGI. So that's the first tax break. Okay. And we've discussed this about, transition into a multi-member, LLC and the tax discount that you get. Now, here's the second tax deduction, which is extremely important. Why it works so well for capitally appreciated assets, such as a piece of real estate or a stock portfolio or a business that you're looking to sell, is that, remember now, if you sell an asset inside this multi-member LLC, 99% of the gain is now pointed to the charity. Does the charity pay tax? It does not, which means that you've just eliminated 99% of the gains tax, and yet the proceeds of the sale of that asset remain as an asset in the LLC, fully under your control. And this LLC is creditor proof, and any assets that grow inside the plan will do so tax-free. So just a couple schematics here to kind of show how this works. You go ahead and you place the asset in the charitable LLC. You've pointed 99% of the gift to the donor advisory fund, retained 1%. So obviously, if you then sell the assets in the Charitable LLC, 99% of the gain is going ahead to be reported to the charity that won't pay tax. You've just effectively reduced your tax on that sale of that capitally appreciated asset by 99%. Yet the results of the sale of the asset remain in the Charitable LLC or the ideal plan under your control. Now, here's the issue then, which is step 4. How do I access the assets? Okay, well, you can usually access them one of two ways. You can pay reasonable managerial fees to the person that manages the LLC. Those are somewhere in the vicinity of, they say, up to 3 to 5% of the assets being managed. So that could be as much as $30,000 to $50,000 a year for somebody that's placed or looking after $1 million that was placed in the Charitable LLC. We have a tendency to sometimes be a little bit more conservative and go to 2 to 3%. And obviously you can't inflate that, linearly. If somebody dumps in 5 million and say that you can, that the managerial fee will be, linearly, you're going to have to cut back on that. But that's the first way that you can get money out back into your hands, which is obviously to pay yourself a management fee, which is reasonable. And obviously, if you do that, that will come back to you taxable. The second way that you can access money is you can make very low interest rate loans. Now, this has got to be a true loan. It needs to be collateralized. You have to have, a loan agreement or a promissory note. You got to do it the right way in case you ever get audited. But you can now access money tax-free because remember, a loan is not taxable income to you. And you can either pay or accumulate the interest now. You can take that money and you can use it for other business purposes. We've had situations where people have sold a business. We've got one we're working on now where a business sale for several $1 million of gain is going to be placed in there before the business is sold, eliminate all the gain, get a large income tax deduction, and then the individual is going to borrow the money back out above and beyond the managerial fee at a very low interest rate. 45 basis points is the intermediate AFR rate right now, maybe tag on a point just to keep things, above board, and then go ahead and pay off mortgages on properties, use it for other real estate development. So you have to understand that that's the second area where you get that. So you can make managerial distributions that are going to be taxable, and you can take tax-free loans that you can use along the way while this charitable strategy is still open until it's consummated and the charitable strategy is shut down and the charity is made whole. And this just basically shows you that you can make these loans, tax-free loans at a very low interest rate back out from the Charitable LLC to the manager or a family member, and then they can actually use that money to create additional wealth, and they can always, use it for other business purposes. And while inside the Charitable LLC, you can invest in a whole multitude of different assets. It could be invested in stocks, funds, real estate, EFTs. So there's a lot of latitude of what you can do inside the Charitable LLC or the ideal plan. Okay. Now, when the manager deems, and this is usually determined upon the inception of setting up the plan, when that plan will dissolve or be terminated, obviously the assets or 99% of the assets, if that's the number of LLC units that were pointed to the charity, has to go to the charity. And you have to consummate that. Now, remember, you can make charitable contributions out of this LLC along the way of different denominations if you want to do it on a present day basis. But theoretically, the charity does not necessarily have to be made whole for whatever terms that you set up on that LLC, which are very flexible, and they can run for multiple generations as a wealth management tool with a creditor-proof, tax-deferred vehicle that can be used on a living basis to create additional wealth in the family that eliminates any tax on gains inside the structure, any tax on sale of a capitally appreciated asset inside the structure, and obviously at the time of contribution creates a large carry forward income tax deduction. Now, what are the advantages and benefits? Let me just say before I get into them, the last step which has to happen is at some point the charity has to be made whole. Now, that could be, as we said, 50, 60 years down the pipe. What many people will do is they will purchase a life insurance policy, either a second to die or a financed insurance policy paying for that policy is a fraction of what your tax savings are, pointed back to the LLC, so they could theoretically use all the assets in there on a living basis to build additional family wealth, but just make sure that the life insurance is there to make the charity or the LLC whole, to make the charity whole at a later date. And in fact, and we'll get into this in our quarterly webinar in January, if you have enough assets, instead of actually capitalizing the purchase of the insurance, you can collateralize it through premium financing. But there are some significant advantages to doing this. There's a substantial income tax deduction equal to the fair market value of a gifted asset, discounted for lack of marketability and control, probably somewhere around 90 cents on the dollar. You reduce, or actually you eliminate, the capital gains by 99% if you sell any assets that are appreciated inside the structure. There's no tax on the investment earnings inside the structure. There's no estate gift or generation skipping taxes of the asset. The asset's creditor proof. The donor retains complete unrestricted control over the use of the assets on a living basis. And obviously, as you saw, because you can take money out via loan, which are tax-free, can draw tax-free income from the LLC and make the LLC whole for the consummation of the donation to the charity with the use of a life insurance policy. Now, I will mention here, and I think there's something to be said for this, our strategic, because people will ask, well, our strategic partner has done this strategy over 1,100 times in the last 20 years, has never had an IRS audit, has had 12 IRS inquiries that never went past an inquiry. And I like when somebody stands behind their work to the point to say that if you ever get audited, we will represent you and not charge you. And if you ever have any penalties from anything that we have done, we will pay them. That's putting your money where your mouth is. So I love the track record of the strategy, and I love the people that stand behind the strategy. Who are your ideal prospects? Obviously, high-income individuals that are looking for substantial additional income tax deductions. Individuals, as we discussed previously, the IRS frowns upon people that make single contributions in a spike income year to a modern pension plan and then shut it down for no good reasonable reason. So people that experience one-time income spikes are excellent candidates for this strategy. It probably wouldn't be a good strategy for the modern pension plan to get a large income tax deduction. Anybody selling a highly capitally appreciated asset that probably has appreciation of greater than $600,000 to $700,000 should be looking at this strategy if they would rather pocket more of the value of their business or that asset as opposed to give it to Uncle Sam. It can also be used in some other complex situations, such as a pension supplement, almost like a top hat, non-qualified deferred comp lookalike. It can be used by C Corp owners with significant retained earnings. And it can be used, as we discussed earlier, to unwind a pension or other qualified asset where you sell or liquidate the asset and then place the residual amount of money into the, or put the full value, it's going to be taxed, but the full value of the asset in after liquidation to the LLC, and then get an income tax deduction, which will offset the income that you would have paid if you liquidated the portfolio, because as you know, qualified assets are taxed as ordinary income. Final word of caution is incomplete gifts. The charity does need to be eventually made whole. And that is very important. You have to consummate it, whether it's 30, 40, 50 years, whatever the terms of the LLC are. Lack of a business purpose can't just be set up for no good reason. There's got to be a legitimate business purpose, but that could just be, for managing money for other purposes that you use along the way in business purposes. And you've got to have proper valuations and discounts. And that's why you always have to hire a fully independent valuation firm. Quick word before we get into a case example, and then we'll open it up for questions and answers, because we're getting a little short on time, is that the use of life insurance, as we discussed, most people that do this strategy will want to use the assets inside of the Charitable LLC or the Ideal Plan, and they'll usually point a second to die life insurance policy that's either capitalized through the payment of premiums or collateralized through the use of premium financing back to the LLC to make the charity whole, guarantee it's made whole, and the consummation of the deal at the fifth step of the strategy. I'm not going to spend a ton of time on this, so we can have at least 5-10 minutes, even if we go over a few minutes for Q&A. is that we had a 64-year-old physician that was making about $500,000 a year. He sold interest in an outside business, and based on the structure of that, experienced most of that as income and some of it is gain. And we're able to use this strategy to significantly reduce taxes. What did it look like? Very simply, if you take his income and you take how much gains that he had gotten and what he got in other income from selling the entity, he was looking at about a 1.85 income for the year. When you look at the difference between base scenario without using the ideal plan or the charitable strategy versus using the charitable strategy, by placing $1 million of those assets, not the full amount, into the strategy, we were able to actually reduce his taxes from $758,000 to $410,000. Now, if you think about that's $350,000 based on the rule of 72, assuming you can get a 7% rate of return, that's an extra $750,000 of wealth in 10 years, 1.5 million in 20 years, 3 million in 30 years, and you get the idea. It's not just about the tax savings, it's about the additional wealth that you create for somebody along the way as a result of those tax savings. So with that said, I will open it up to any questions, Donna, that any
Yeah, we did have a couple of questions come in, Fran and Jean, thank you. One of the first questions we had was, if we have a potential client situation we would like to run by you, what is the protocol?
Jean, you can take that since I just got done talking.
I mean, the best protocol is just pick up the phone and give us a call and kind of give us an overview, and we'll just chat on the phone and explain if we think, you know, this is doable and not doable. If it, you know, if either of these strategies will work. I mean, we actually had a conversation this morning with another advisor, and he said, this is my client. And, you know, we, in 10 minutes, we kind of determined there was nothing there for this, but there were other strategies we could do. So more than well, you know, more than open to talk to anybody about anything. And usually within 10 minutes, we can kind of figure out if there's a need to talk further or a purpose of talking further.
Yeah, and the only thing I would add to that is if we have a CPA or a tax attorney that discusses a case with us, we're always respectful that that is their client. We discuss it with them. We determine whether or not the strategy may be applicable. We educate them as to how it works so they can bring it back to the client, and nothing ever gets brought to the client till they write off on.
Next question. I have a client that is looking to sell their business and will probably have about 500,000 gain and would likely have an income around 200,000 moving forward. Is that a potential candidate for a charitable LLC?
That's a great question, and that's right up the alley of what we were just discussing. And the answer is no. There are probably other strategies we could use, but the reason is the income's not large enough moving forward to take maximal advantage of the income deduction. And remember, there's a cost to set up these plans. You know, the base cost to set up these strategies is about $50,000. So when you look at that minimal amount of gain and the tax that would be on that, from a gains tax standpoint, the cost of setting up the plan and not being able to maximize really because of the little bit lower income over time, the tax deduction, I would say probably not a good candidate for the ideal plan.
Next one. I have a cosmetic dentist in private practice who is 38 years old, netting about 1 million per year income. He has a staff of 4. Is he a candidate for a modern pension plan?
Well, that's actually almost exactly what, you know, the example we did before. And the answer is sure, he might be. I mean, you know, assuming he's saving money and he wants to shelter money, absolutely. Once again, that's a great conversation to have. You know, we can do a study and everybody will decide either it makes sense or doesn't make sense. Just do the math.
Awesome. Next question. What is the cost for a preliminary analysis for either the modern pension plan or the charitable LLC?
You're going to love this. The answer is nothing. We do complementary analysis. We don't want to ever get anybody involved in a strategy or have to come out of pocket until we understand that the strategy is going to work and make sense for them. And if there's a strategic advisor involved that they write off on.
Awesome. And our final question, which would put us right on target for ending on time. If a client purchases life insurance inside a modern pension plan, how does he or she get it out of the plan at a later date?
Great question. There are multiple options. Option number 1 is you can distribute it out as an asset and pay tax on the distribution. So if you got 500,000 in cash, you would pay taxes. Option number 2 is you can literally buy it out for whatever the cash value is. Option number 3 is you can take a maximum loan inside the plan and pass it on out. So there are multiple options which you can do.
Awesome. Well, thank you for joining us. And we look forward for you to join us on our next case study, the value of a insurance policy audit on Tuesday, November 16th at 1 p.m.
Thanks, everybody, for attending.